Hello, my name is Anthony Enriquez, and today we'll be going over 3 policy illustrations. In all 3 designs, you will see the same premium amount going in, but different results. We want to show how one IUL product can be changed in many different ways. Typically what you'll hear industry-wide as far as make sure your IUL is set up and designed properly. That's exactly what I want to show you today. What is a correct design when looking for a solution that may fit your current situation? What you'll typically see, and max funded in just 3 years. Here you're going to see a policy I just designed for myself, just to give us an example. And what I have here shown is just $1,000 a month going into the policy for my entire working years. The numbers that you see on screen will be end of the year numbers. So that means this is just the monthly contribution of $1,000 a month for the entire year, or $12,000 annually. Over here on the left, as you can see, I am 31 years old. With every policy, there is going to be a health rating assigned to your policy based on your current health. There is Preferred Plus, which is going to be like your ultimate athlete. It's going to be Preferred, somebody that works out pretty often, is pretty healthy. Select is just going to be below that one. And then Standard or Average, that's pretty much what the majority of people are going to fall into that category. And below Standard is just going to be a rated policy. I just ran this one on a non-tobacco, also known as a standard health rating. The specified amount is going to be $500,000. That's going to be our death benefit. Next, you'll see option A. This is just the type of death benefit that we select. Industry-wide, you're pretty much going to hear option B or death benefit option 2, meaning that the policy is going to increase in death benefit over time. With the flip design, we select option A. That's because it is going to be a level death benefit. And like I said, the premium that I'm comfortable saving is $1,000 a month in this scenario. The premium, that's just going to be the money that goes into the policy. Our annual outlay, that is going to tell us the exact amount that is left in the policy. As you can see, that number is going to be the same in this case, $12,000. We're going to have 3 different columns showing us the different values that you can assume in an IUL policy. So in this first column, which is going to be in between those lines there, this is going to show our guaranteed policy value. Now, for this column, this is going to show the returns of the stock market being 0 or even below 0 the entire time of this policy. So just that being said, that is very rare to assume that the stock market is going to be negative the entire time of this policy. But as a guarantee, the insurance company must show you worst case scenario. This is also stating that the price of the insurance is going to rise to the maximum. And for that to be done, they would actually have to change the current regulation and increase it to the maximum. Our non-guaranteed policy values, assuming a 4% return for the lifetime of the policy, which the policy actually does allow you to select a guaranteed fixed strategy. And it's currently at that 4% that you see there on screen. And that right column is going to show your actual stock market returns, assuming a 5.92% return for the lifetime of this policy. You can see here that by putting in $12,000 for the year, the death benefit is going to be $500,000. Our net account value, which is the amount of money that we have in the policy minus the fees, and the far right column is going to be our cash surrender value. Or in other words, that is going to show the equity of this account at any given year. And as you can see, this policy is going to grow. If I would have put $12,000 for the entire time of the policy, from when I first started the policy all the way to when I was 65 years old, my anticipated age of retirement, I would have put in $408,000 into the policy. The policy would be just shy of $1.7 million there as far as death benefit amount, and the policy equity would be at 1.16 in equity available at that time. Now, this is going to be your standard design. Many agents are going to design a policy similar to this. Now, let me show you what a max funded policy looks like. Okay, so here we're going to see one distinct change. This is still a design on myself, age 31, non-tobacco, so those are going to remain the same. One major difference is going to be our specified amount or our death benefit. That amount is going to be a specific number. In this case, 204,119 is going to be the specific death benefit, because we were going to decrease the death benefit as much as we can based on the IRS guidelines of the specific premium amount that I'm comfortable putting into the policy. We design all of our policies as far as the flip design based on the comfortable amount that the client is able to contribute at the given time when we set the policy up. that's how that number is going to be determined as far as the monthly premium or annual premium. The same outlay is going to consist in this policy. We have $12,000 going into the policy, $12,000 being the annual outlay. And let's jump over to the assumed value from the index, that 5.92%. One of the major differences, by lowering our death benefit, two things are going to occur. We're paying naturally for less cost because we have a lower death benefit, so we have more net account value, as well as our cash surrender value is extremely higher, aka we have way more equity to access within the first year. And let me just go back to the previous one so you can take a look at the difference between the two. So in this policy, $500,000 is going to be the death benefit amount or specified amount, and you can see our cash surrender value is just almost $2,000 there. Now in this next design, you can see there's way more equity within that first year. Now let's see how this one performs throughout the working years. We're going to consistently put in the $12,000 until age 65, and you can see that number is going to remain the same, the 408. We would have actually more death benefit at that point in time, 1.7, as well as net cash value, 1.2 at that point in time. So in this design, I also showed distribution, or taking funds for the remainder of my life in the amount of $66,000, and that's going to be that negative number there. That money is actually coming from our equity column here, and that's going to be the amount of money being returned to my bank account from the growth of this policy. Now, I'm simply going to scroll down, and you can see $66,000 for the remainder of my life is able to comfortably come out of this account. I'm just going to pause it here at 91. I would have put in total throughout my working years, $408,000 into the policy. Up until this point, I would have taken out just over $1.7 million in tax-free distributions via loan from this policy, as well as there would still be a net death benefit to my heirs, meaning the money that I took out in loans, I was collateralizing my death benefit while I was living, and there would still be an excess amount going to my beneficiaries in the amount of just over $1.5 million to go to the next generations tax-free. This illustration being shown is a large commitment of annually putting in $12,000 into this account. Many of us may not be able to commit for a long duration of time like that to a policy. So this next illustration is just going to show 3 years of premiums going into the policy and what that looks like as far as a max funded IUL. This is exactly the same policy, but on a shorter time horizon as far as premiums going into the account. The premium is going to be the same of $12,000 or $1,000 a month, and we're just going to do that for the first 3 years. So that is a total of $36,000 being saved in the policy, and I want you to notice exactly what happens based on just those 3 years of funding, how this policy will grow and mature over the years. Let's take our eyes to the far right column again. As you can see, our net account value is still going to be the same as our last policy, slightly over $11,000 there. And then in our cash surrender value, it is going to be slightly over $10,000 in the following column. Let's see exactly how long only funding this policy to the max for 3 years will last in this policy. So as we scroll down, I'm just going to stop at age 65. You can see up until this point, even though we haven't funded this policy for literally years, the policy is still growing, just because there is an account value that has been captured in the first 3 years that is going to generate interest every year based on stock market growth. Now, the returns in this account are going to have a 0% floor. If the S&P 500 returns less than 0, none of your principal is going to be lost in this account. You might have heard IULs as 0 being the hero, meaning it's better to receive a 0 than receive a negative. On the upside, the S&P 500 is typically going to be capped right around 10% on average. So if the market is above 0, you are going to receive whatever the credit is up to that cap of 10%. I'm just going to continue this same policy design down to 91 as we looked at in the following policy. And up until this point, this is only showing, again, $36,000 being saved within the first 3 years. The death benefit at this point in time would be just over $800,000, and the account value would be $745,000 at that point in time. And this is not to get confused. This is not the flip design quite yet. This is just to point out there are many different ways to design an IUL policy. Even though this is the same product with the same carrier with the same rating, the amounts of money going into the policy are the same, but the actual design are going to impact the growth as well as the access you have to your cash. So make sure you're talking to an IUL specialist when you're looking for max cash value accumulation, because this can be a great tool, but when designed improperly, this also can lead to loss of thousands, if not hundreds of thousands of dollars. And this is why we like to spread the knowledge, breaking down the terms as well as the designs that you might see out there, because we don't want it to be a guesstimate at what you should be looking for. And that's why if you have any more questions, hit the link down below, and I look forward to talking to you.